Welcome to the pit. I'm Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. Now let's get into today's numbers. I recently published a screener piece that contained a critical data error. That single oversight cascaded into multiple pricing errors, and you, the community, rightly called me out on it. Today, we are setting the record straight with the fully verified Q2 2026 forensic audit. The error happened because the InvestingPro screener I used mixed currency denominations. Some figures were pulled in USD, others in SGD. Because I didn't catch it during my review, it cascaded into completely wrong share prices and incorrect yields, especially for CapitaLand India Trust. I want to say this clearly and without any deflection. Bad, inaccurate content is worse than no content at all. There are absolutely no excuses for what happened here. This platform is built on uncompromised data integrity, and I failed to uphold that very strict standard in the original drop. The entire premise of the Investing Iguana is forensic discipline and absolute data integrity. Publishing unverified figures contradicts everything we do here. So I pulled the original article entirely and rewrote it from scratch. Every single material figure you are about to hear has been cross-verified against primary sources as of the 7th of April 2026. We are pulling directly from official SGX announcements, InvestingPro models, and independent third-party sources to ensure complete bulletproof accuracy across the board. Every number is checked against its primary source. I want to take a moment to genuinely thank every single reader who messaged, commented, and pushed back on those errors. You are exactly the community this platform was built for. You are readers who pay attention, who read carefully, and who hold me to the exact same forensic standard I claim to hold the broader market to. That level of accountability matters deeply to me, and I do not take it lightly. Now that the record is clear, let's do this properly and dive into the actual numbers. In this current market environment, the window for action closes incredibly fast. The difference between securing a true financial sanctuary and stepping blindly into a toxic yield trap is very often decided in a single trading session. By the time this deep dive analysis reaches you on the free tier, the entry window I identified has already opened, and very frequently it has already closed. That is simply the reality of how fast institutional capital moves when the setup is fundamentally right. That is exactly why Iggy's elite investors exist. They do not wait for the market to fully price the data in. They get 0-day access to these complete forensic breakdowns, the full red zone watch list, and institutional grade cheat sheets the exact moment the setup goes live. For 9 Singapore dollars a month, which is less than a kopi and kaya toast set at Raffles Place, you can stop being the market's exit liquidity and start being the analyst who front runs the crowd. Today, we are tackling the yield trap paradox head on with the Q2 2026 screener. When the market is running hot, the most dangerous thing you can do is blindly chase yield without understanding the structural integrity of the asset paying it. We are going to deploy a ruthless multi-factor filter to strip away the noise and find the true bedrock assets hiding in plain sight on the Singapore Exchange. In February 2026, the Straits Times Index shattered the historic 5,000-point resistance level, reaching an all-time intraday high of 5,017. Since then, it has retraced to 4,898, as at the 27th of March. This unprecedented rally has completely shifted the psychology of the retail investing ecosystem, and frankly, a dangerous level of complacency is settling into the market right now. When those index charts start painting vertical green lines, discipline goes completely out the window. Average investors stop reading balance sheets. They start chasing momentum, deploying their hard-earned CPF ordinary account and SRS funds into assets they fundamentally do not understand. They see an engineered dividend yield or a brief surge in share price and jump in blind. This is the exact moment when capital preservation must become your ultimate obsession. In a high market environment, heavily indebted companies artificially inflate payouts to attract retail liquidity. They mask structural decay while their net asset value quietly bleeds out. For the 50-plus Singaporean investor, a 30% capital wipeout 5 years before retirement is sheer financial negligence. We are not looking for speculative noise today. We are hunting for true sanctuaries, assets that offer genuine capital protection during macro volatility and sudden rate shocks. To find these sanctuaries, I designed a ruthless multi-factor screener. We strictly demand a market capitalization greater than 1 billion Singapore dollars for institutional liquidity. The dividend yield must be strictly above 4%. The price to earnings ratio must sit below 20 times because we refuse to overpay for future earnings. Finally, there must be a fair value upside greater than 5% to ensure a mathematical margin of safety. Out of the hundreds of listed entities on the exchange, only 8 survived that draconian filter. Today, we are subjecting the top 5 candidates to our mandatory 5-layer analytical flaw. Every single metric will be comprehensively cross-examined for solvency, wealth generation, and valuation. We are filtering the entire exchange down to its absolute structural bedrock to separate the genuine wealth compounders from the toxic yield traps that look appealing on the surface. Step 1 is the health check, where we interrogate solvency. Before we even acknowledge a company's dividend yield, we must interrogate its debt. A high yield from a highly leveraged company is just an advance on a future rights issue. When evaluating solvency, having a fortress balance sheet is absolutely non-negotiable. If the debt structure is unstable, the yield is an illusion and we walk away immediately. Think of a company's gearing limit exactly like an impending HDB lift upgrade. If the town council manages its sinking fund perfectly with low gearing, the upgrade is smooth. But if they are maxed out on debt and lifts break down, they come knocking for a sudden lump sum payment. In the stock market, that sudden knock is a highly dilutive rights issue. We demand gearing below 35% and an Altman Z-Score above 3.0 so the company absorbs the cost, not you. Looking at the financial health checklist, we verify every single metric. Mapletree Industrial Trust sits at 37.2% gearing, while Capital and India Trust is at 39.6%. ComfortDelGro operates with a highly conservative estimated 25%. We rigorously track the Altman Z-Score to predict bankruptcy risk, and Jardine, Cycle, and Carriage and Thai Beverage both boast massive scores of 6.8 and 7.9 respectively, placing them well into the safe zone. At 37.2%, Mapletree Industrial Trust sits marginally above our 35% forensic ceiling. This is a yellow flag, not a red flag, as the MAS hard cap is 50%, leaving meaningful headroom. Its interest coverage ratio of 3.9 times is just below our preferred comfort level. Neither disqualifies the trust, but together, it means this isn't the most conservative balance sheet, and you must size your positions accordingly. Capital and India Trust is classified as a business trust, meaning it is not subject to the 50% SREIT gearing cap. Its 39.6% gearing is not a regulatory breach, but it does exceed my personal forensic standard. The remaining balance sheets provide stronger structural comfort, with Thai Beverage at a Z-score of 7.9. These balance sheets have the necessary steel to survive ongoing macro volatility. Step 2 is the wealth check, where we rigorously evaluate yield and cash flow. The latest 6-month MAS T-bill auctioned at 1.46%, and the 1-month SORA has stabilized near 1.13%. But in forensic analysis, we never price assets based on today's calm weather. We must ensure the compensation offered for our capital today truly justifies the risk we are taking on these equities for the long term. We apply a conservative base rate floor of 3.2% plus a mandatory 150 basis points of risk premium. This creates an absolute minimum yield hurdle of 4.7%. We never use the live fluctuating T-bill rate to justify a risky purchase, because we audit for the storm, not just the sunny day. If a stock cannot clear that 4.7% hurdle, it fails the wealth check. Capital and India Trust trades at 1.02 Singapore dollars with a verifiable trailing yield of 7.7%, based on its confirmed FY 2025 DPU. This yield represents a solid premium to its 5-year historical average, meaning the unit price hasn't caught up to its improved cash generation. It operates as a pure-play growth vehicle for Indian IT parks and data centers across major hubs like Bangalore and Mumbai. If we inject a severe stress test scenario, a 10% sudden depreciation of the Indian rupee, the adjusted yield sits near 6.9%, safely above our hurdle. With 72.6% of borrowings at fixed rates, it is well protected. For an investor relying on income, the massive risk premium over the T-bill absorbs the currency shock and the elevated gearing risk. The gearing is the price of admission, so size accordingly. Mapletree Industrial Trust is priced at 1.95 Singapore dollars with a dividend yield of 6.7%. Securing it at this yield means capturing a meaningful premium over its 10-year median yield. The market is pricing in more uncertainty than the underlying cash flows justify, especially given its impressive portfolio of 136 properties and the deliberate pivot toward North American data centers to capture future tech growth. This trust is increasingly an artificial intelligence infrastructure proxy. A sustained acceleration in corporate AI cloud spending will directly compress vacancy rates across its North American data center portfolio, enabling positive rental reversions. The 6.7% yield creates a 524 basis point risk premium over the T-bill. This provides an inflation-pacing income engine that has impressively maintained distributions for 16 consecutive years. Think of weighted average lease expiry exactly like a long-term wet market stall lease. If a fishmonger signs a secure 5-year contract, the town council comfortably predicts its income. But if they rent month to month, the council sweats every time foot traffic drops. For industrial trusts, a long WALE anchored by large tech tenants ensures that the dividend you receive today is mathematically protected from sudden tenant evictions tomorrow, securing your income stream. ComfortDelGro is priced at 1.44 Singapore dollars, delivering a trailing yield of 5.9%. The upcoming May dividend implies a forward yield of approximately 6.3%. This confirms the post-pandemic earnings recovery has firmly taken root, supported by a record FY 2025 revenue of over 5 billion Singapore dollars. With a massive fleet of 34,000 vehicles, its beta sits materially below 1. If broad market sentiment drops 10%, ComfortDelGro's revenue remains largely insulated. A market crash does not stop a million Singaporeans from taking the bus, the MRT, or booking a taxi. Its utility is highly inelastic. This 5.9% yield is a predictable, resilient cash flow source. It is the financial equivalent of keeping your umbrella in your bag boring when it is sunny, but a total lifesaver when the storm hits. Step 3 is the price check. We have verified solvency and confirmed the cash flow, but buying a phenomenal company at a terrible price makes it a terrible investment. We are hunting for the forensic gap, the mathematical discrepancy between a company's fundamental fair value and the emotional price quoted on the exchange today. We want fundamentally sound assets that the broader market is mispricing due to superficial fears or temporary industry headwinds. Valuation is exactly like walking down the aisle at NTUC fair price. You see a premium imported olive oil marked down 40% just because the tin has a slight dent, while the standard house brand sells at full price. The oil inside the dented tin is structurally perfect, but the market avoids it due to aesthetics. Buying that dented premium tin is how we capture fair value upside. Acquiring perfect cash flows, the market is too fearful to price correctly. If you want to know exactly when I execute these value trades, Iggy's elite investors get the full red zone watchlist and 0-day alerts. The link is below. Our peer comparison table breaks down the exact valuation gaps. Jardine Cycle and Carriage shows a massive 45.6% InvestingPro fair value upside. Maplet Tree Industrial Trust shows a 41.2% upside, which is highly unusual for a large-cap industrial asset. Thai Beverage presents a 22.1% upside. These figures represent genuine mathematical margins of safety built into the current share prices of these thoroughly vetted companies. Reading these valuation gaps requires structural nuance. Jardine Cycle and Carriage's upside comes from a composite model, reflecting genuine disagreement on valuing a complex conglomerate, requiring a longer time horizon. For Maplet Tree Industrial Trust, the market is pricing in sustained DPU pressure, but its deep data center pivot and 16-year distribution track record strongly suggest this heavy discount will not persist indefinitely. These are real opportunities for the patient capital allocator. Jardine Cycle and Carriage trades at 34.04 Singapore dollars with a compressed price-to-earnings ratio of 10.5 times. It has already delivered a 1-year total return of over 50%, meaning the re-rating thesis is actively underway. It suffers from the classic conglomerate discount because the market struggles to accurately price its complex web of Southeast Asian assets, most notably its massive majority stake in Astra International in Indonesia. A structural recovery in Indonesian automotive sales and heavy machinery demand would heavily accelerate the institutional re-rating of this stock. The 45.6% upside implies this gap will close. Timing is the only variable. While its 4.3% yield slightly misses our hurdle, the capital structure arbitrage makes it worthwhile. The mathematical compounding of capital appreciation structurally outweighs the minor yield shortfall for the patient value allocator. Thai Beverage is sitting at 42 Singapore cents, the very bottom of its 52-week range, carrying a trailing yield of 5.7% and a 22.1% fair value upside. You are buying structural value at a moment of peak pessimism. Fitch recently revised its outlook to negative, citing consumption headwinds and leverage, which is a material disclosure. The path to re-rating carries macro dependency, but the underlying value is undeniable. Thai Beverage dominates the regional food and beverage space through Chang Beer and its massive spirits division. A 10% uptick in broader regional tourism and domestic consumer spending acts as a direct multiplier to top-line revenue. Backed by a Z-score of 7.9, it turns regional consumption directly into SGD cash flow. At the 52-week low, the risk-reward is heavily skewed toward the upside for a patient income investor. Have you ever watched the frantic rush when the MRT doors open at Jurong East? People violently shove their way onto a packed train, ignoring the empty, perfectly functional train arriving 2 minutes later. That is exactly how retail investors behave during a 5,000-point STI rally. Chasing crowded yields, the forensic wealth builder steps back, audits the balance sheets, and quietly boards the structurally sound assets trading at a discount. Patience is a financial weapon. Step 4 is the bottom line. We do not deal in hype, and we strictly do not issue blind buy, sell, or hold directives. The market changes daily, but our forensic methodology remains completely static. Based on this thorough Q2 2026 audit, here is the strategic stance for these assets, categorized by their specific utility within a mature, resilient wealth-building portfolio designed to completely outlast the current emotional market cycle. First is the Bedok blueprint for high-income focus. For the investor whose sole objective is to crush the CPF special account benchmark, CapitaLand India Trust and Mapletree Industrial Trust fit the profile. Like the mature, unshakable estates of Bedok, these assets deliver consistent, heavy utility year after year. Just remember to actively size your positions relative to your risk tolerance, given their slightly elevated gearing levels. Next is the Jurong Shield, our defensive anchor. For the retiree who prioritizes sleep at night stability over aggressive capital gains, ComfortDelGro serves as the ultimate anchor. Armed with a low beta and record revenue, it is the industrial-grade shield that prevents your portfolio from capsizing when macro volatility strikes. The upcoming May 2026 ex-dividend date provides an imminent and highly predictable income catalyst. Finally, the Tanjong Pagar pivot for value and appreciation. Jardine Cycle and Carriage and Thai Beverage offer profound fair value gaps. Like a beautifully preserved Tanjong Pagar shophouse, the market currently underestimates their intrinsic worth. You collect a steady rent while waiting for institutional capital to inevitably reprice the asset. Just monitor the Fitch negative outlook on Thai Beverage as a critical risk signal for your position sizing. The STI crossed 5,000 and the euphoria has not left the market. Let the crowd chase the noise. You stick to the 5-layer floor, you demand a fortress balance sheet, and you never settle for an engineered yield. If you want the real-time alerts when these entry windows open, join Iggy's Elite Investors. The link is in the description to secure your 0-day access. Stop being exit liquidity and start being the analyst. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security. All data sourced from InvestingPro, public SGX filings, and verified third-party sources as at 7th April 2026. Altman Z-Score sourced from InvestingPro and not independently recalculated. All investments carry risk, including potential loss of principal. Past performance is not indicative of future results. If making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.